Hi, welcome to globalinvestorradio.com. This is part 2 of the Humphrey B Neill, the Ruminator series, and also I just thought I'd add a couple of longer term gold charts just to discuss the long term price trend. It seems to be quite a hot topic with a lot of different people at the moment. I like this quote from Humphrey B Neill: as gold fluctuates, so do the thoughts of speculators, and how true that was, especially in 2011. Here's the gold monthly chart going back all the way to 1988, and as you can see, the peak in 2011 just around the $1,900 mark. We had good base level action, a slow steady rise, one base consolidation here where my mouse is, one here where my mouse is, one much larger one here during the Great Recession crash, another consolidation here, and another one here, and a top area here. And this was easy to tell that it was distribution when it shot up from 1500 to 1900, and during those months of 2011 it was a highly volatile market. You could tell it was distribution. Anyone who's got any long-term experience in the market, you go back throughout history, whenever tops come about in the market, it's always followed by high volume and high volatility as well. And you can see it here in the gold top with 3 or 4 triple tops here and a nice movement down. I can see the price settling perhaps somewhere around the $1,000 level at some point in the next 6 months to a year, although I'm not sure, or nor do I have any confidence really in that opinion. It's a market that I'm not trading at the moment. It's okay not to trade. It's okay not to know in what direction the market may be going, and that's when you stand back from the market and take a seat and watch the market until it gives you clues that it's A, building another base, or B, producing another consolidation area for another spike downwards. So really at the moment it's a wait and see, but my way of thinking at the moment is that it's going to join up, revert to the mean somewhere along where my mouse is, $900 to $1,000 an ounce, and it will settle down around that consolidating level. We could see it perhaps around 1100, settle down there, but from here I do feel that the market is going lower. But again, I'm not really trading this market. Here's another monthly chart which I think's a beautiful looking chart, and you see the nice upward movement and the distribution at the top here. And in reality it's cut the downtrend. Wouldn't be surprised if we did see a spike up at some point, but it won't last, I don't think, and it will be what Livermore used to call sucker bait really. And again, getting back to that point where I was talking about a spike up, if you look to where my mouse is now and I'm drawing a trend line down there, we could see it reach the 1400 level, and if it did build some consolidation there, I may well change my mind. But I think it could maybe well spike up to 1400, but in the next 6 months to a year I do suspect that it's going to come back down to around the $1,000 level. I still think the downtrend is in effect, but usually what happens, especially when we've got distribution, and where my mouse is you can see the breakout from that distribution, these pivotal points here, it is a sign of weakness in the market. But quite often when too many people jump onto a trend, they'll shift the market back up to 1500, and that's where it will bust out quite a few players, and then we'll see the big downward move to 1000. Perhaps that's how it will play out, perhaps it won't. Now this section of the Ruminator, it's a segment of gold history from an article written in 1973, I believe that was the year it was written, by Humphrey B Neill, and it just relates some of the goings on in the gold market throughout the years. The gold standard as we know it is relatively a modern monetary system dating from 1774 in England, about the time of the Industrial Revolution and the American Revolution. In the United States, however, we operated our personal affairs and commercial undertakings on the bimetallic standard until the Act of 1853. We were off gold from the early Civil War days until January the 1st, 1879. The Special Resumption Act of 1873 put us squarely on the single gold standard, which finally went into effect in January 1879. It is helpful to an understanding of the monetary system to recognize that although gold has more desirable qualities and is more trustworthy as a standard of value than any other commodity, excuse me, the facts are that nations have been going on and off gold and devaluating their currencies with aggravating monotony. To complete the rundown, the United States abandoned the convertible gold standard as we know it to our regrets in 1933, and in 1934 re-evaluated gold at $35 an ounce from $20.67 an ounce. Over 40 countries had suspended gold payments in 1931-32, following Great Britain's devaluation of the pound sterling on September the 21st, 1933. Now, a generation later, we find ourselves in a two-price gold era, an official figure of 42.22 an ounce, and a fluctuating market price. Again, gold is attracting world attention, has become once more a gambling commodity, as well as a monetary medium of international trade. As for a store of value, first, we Americans can't buy it, and second, its value fluctuates in accordance with demands and supplies from all points of the compass, including South Africa, where the big gold mines are located. While gold is presently gyrating in price as wildly as in the New York gold market of a century ago, nevertheless, predictions on the future of gold are at best a random shot. Anything as sought after as gold is certain to cause pain as well as pleasure. Even a brief reading of the history of currencies makes one realize the temptations of rulers and dictators to depreciate their coinage by various methods such as clipping and alloying. Incidentally, I wonder where in history one finds a grosser job of alloying than has occurred in our copper sandwiches. There have been numerous depreciations of the English shilling and the French sou, and of the Italian coins. A contrarian may ponder what the final outcome will be of our mutilated silver coins. Those who were in France in 1918 will recall how the peasants and working people charily counted out their big copper sous when about to purchase bread and wine. It was not long before the sou was worthless as a medium of exchange. Gold has been a popular speculative vehicle as well as a monetary medium. Speculation occurs with any commodity that changes in price. In the case of gold, speculation occurs in the commodities that measures the values of other commodities. The result of gold speculation, in consequence, can cause economic turbulence at times. Let us go back 100 years to the greenback era, when gold was traded from morning till night in gold markets and in hotel lobbies. Because of the demands of the Civil War, gold was abandoned in 1861, and the paper dollar, to be known ever after as greenbacks, fast depreciated in value. There was in the South, the Confederacy commenced printing paper money of various denominations, as they had to have something as a medium of exchange. At the outbreak of the Civil War in April 1861, a minor stock market break in New York was the forerunner of a financial crisis later in the year, which in turn resulted in New York's banks suspending specie payments to stop the drain on their gold. The first insurance of greenbacks occurred in February 1862. Untied to and unbacked by gold, gold was quickly hoarded. Speculation immediately was rife. As the price of gold was pushed up, the greenbacks lost value, until at worst these paper dollars sank to 35 cents relative to gold, and this meant that purchasing power decreased sharply because of inflated gold prices. It cost the government dearly in its war expenditures, and everybody felt the pinch, of course. In October 1864, the New York Gold Exchange was formed. Speculation increased enormously. Eventually, trading had been active at the old Fifth Avenue Hotel until banned because the boys were too noisy. In 1864, a magnificent building was constructed at the corner of Broadway and 24th Street, adjoining the hotel, called Gallagher's Evening Exchange. It enjoyed a nightly attendance of 600, sometimes rising to 1,200, when excitement became feverish. The Black Day for gold, as readers will recall, was September the 24th, 1869, known ever since as Black Friday, when Jay Gould, with the aid of James Fisk, tried to corner gold. Through Washington connections and contact with A.C. Corbin, President Grant's brother-in-law, Gould thought he could prevent the government from selling gold from its reserves. It is pleasant to relate that U.S. Grant saw through the wicked scheme, and at the crucial moment, with gold selling at 155 and just touching 160, a wire arrived on the floor of the exchange reading, "The Treasury will sell at 12 o'clock noon tomorrow 4 million gold and buy 4 million bonds. Proposals will be received in the usual form. Daniel Butterfield, Assistant Treasurer." In today's language, this was the end of the ball game. Gould had been sneakily unloading some of his gold when he began to wonder if the president might not get wise at what he was up to. His confederates, however, were cleaned, and several went into bankruptcy. Brokers too went bust. The penalties were indeed sad to record: failures, suicide, and ruin. Thus ends a short account of gold, which we liberty-loving Americans are not permitted to buy. Our ownership can only be as shareholders in gold mines. As gold fluctuates, so do the thoughts of speculators. And I found that article very informative. It gives you a good rundown of a segment of gold history, and I'll be uploading some more screencasts on Humphrey B Neill in the very near future. Again, check out Oak Trader Report, released every Sunday before 11 p.m. Hong Kong time, and we follow the trading methods and techniques of Humphrey B Neill. Over and out, and I'll speak to you soon. Bye for now.